Once we broke our line in the sand on the 21st, we started our move lower. But is it time to panic? Why did we bounce so strong on Friday? Last week, we mentioned the ending of a business cycle that would lead to the market being more free. Do you know when and why this occurs? We'll dive into those and more today as we get prepared for the week ahead. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Speaking of time to panic,
What did one index say to the other when it was falling? Hang in there. I'm sure we'll bounce back.
and bounce back we did. We came right into the area where we knew our market makers would be flush with capital and could trap everyone. And our students have access to this information. And we knew to watch at that 48 half. We have a level there that was right to the tick for low of day. And we knew that that was right where in this 54 to 50 area that our market makers would start jumping in with lots of capital to deploy. And if you understand the flow aspect of the business and when and why we'll bounce back, you can trade along with the billions that actually move the market.
Our washing machine returned this week, and zooming out, we are still in the same rinse and repeat cycle since November.
That's right. We are still in the same rinse and repeat cycle that we've been in for quite a while. We can look at this in terms of assessing that position that commercials are net short. And we see here that they're still net short. But since we've gone short and we track when they add and where this position is, you can see that every time we get up, we start to make a move back lower. And this has been ongoing since the election, and it's just been that big washing machine we've talked about time and time again. We made new all-time highs, but we have yet to break that elusive November 5th low. Why did we move down so much this week, and what can you do to prepare? We'll cover that as we go through, but first we're going to go through all of these positionings. Last week we mentioned that commercials on the VIX, so on the volatility index, we're adding a net long position to the highest levels that we've seen since the Japanese yen and the central bank ended the yield curve control and started raising rates. And since last April, when we had our big move down, and again, that was a business cycle move. And we mentioned last week to be on the lookout for downside, and that didn't disappoint. As commercials buy volatility, we want to be aware of the potential for downside in the indices, as that is where they will make their money. And viewing the short position can help us view the context of the last few months. And we monitor and track these points for all instruments so it can help to give us a clear edge. And we can also look at the yen, which is giving a 3 year and 1 year max short position. And if you go back and you look, the last time we hit very large max short position in relation to our 1 and 3 year levels, that was in September of last year. That didn't end well for these large speculators that are constantly trying to bet against that trend. And we saw as they got fully short from our commercial side, the market dropped and they took everybody's money. And what happens in these large moves in the market, and we mentioned this before, that as we got up here, our market makers are going short. We broke our line in the sand. Our active investment managers and our passive managers are both getting all their cash invested in the market and then getting shaken out on the downside. So that is taking out those performance chasers, not to mention retail.
What is a trader's favorite exercise? Jumping to conclusions.
Jumping to conclusions. Yep. So when you jump to a conclusion and not expect the market to bounce back, and you're expecting only downside, or you're expecting the dip to keep being bought, but you don't know when, you get yourself lost in the moves of the market and all the minute details. So let's go through this past week and see everything that happened. So if you are unfamiliar with OPEX, that cycle ended. It runs on a monthly cycle, but it's offset. It's not a calendar month. And that ended on February 21st. So we mentioned in last week's video that this opened the door for a potential downside move or just open the market up for a move to break free. Now, when we look at where we are in our relation to our bands, to our levels, to everything that we look at, we were getting too close to the top edge. So again, once that business cycle ends, we have freedom to move. And that won't affect us until we have trillions coming due again in the next month. And if you go back and you look at what happened during COVID, it followed the exact same business cycle. And you can go back to April of last year and the exact same business cycle played out, where we had our bottoming in to the end of the cycle. And prior to that, the previous cycle had stayed contained until that day. And then the market opened up and we could see these business cycles and how they play out. And we go through this extensively with our students in multiple lessons and multiple sessions consistently. And once we have now on that Friday, once we had that trillions of dollars and that forced compact move being taken out, we could sit here and go through our daily plans and expect the market to move a little more, especially once we break that line in the sand. The market is known to move more directionally with wider ranges, better and cleaner moves, and we understand how to capitalize on that. And I hope you guys are learning this too. And in terms of our daily expectations, we had a lot of catalysts this week, especially Wednesday with NVIDIA earnings after the bell. And we mentioned that we were looking on that daily session, that we were looking for the downside into that end of the day, that we would see the market find a bid for the insurance in the market, and we were going to look for a downside move. And as soon as 12:30 hit and we get all of the morning session cleared out, we made our move lower for the rest of the day. And we could see this and monitor this at 9:30. We were very underhedged, underinsured, and underprepared for the day. And by 12:30, we were seeing that demand for that insurance coming in. And by 1:30, again, we're seeing that bid pushing us up, pushing us up. And it had to be for the 27th because the session ended for the 26th before NVIDIA's earnings. Those come out after the bell. So we can follow this. And then we mentioned that we would likely see a more muted response on NVIDIA earnings. And it was. It was fairly contained. We put that in for our subscribers. We gave them levels to trade off of, and it wasn't anything we were expecting. Uh, we weren't expecting anything drastic. It was everything we were expecting in terms of our levels and our plans for it. And most of our students did not trade it as it wasn't a huge edge as it's been in the past. But there were plenty of opportunities then for the rest of the week. And what we saw play out was on Thursday, we had the market and we watched our insurance again. We want to pay attention to this every day as this is critical in understanding how all of this plays out and affects the markets. And so on Thursday, on the 27th here, we had, and you can see down here, we have this is our proprietary indicator that shows us the demand and supply of that insurance in the market. And we can see when it comes to our critical points, everybody's bought, downside's likely done, and we turned, and that's when we can look for the market to rally. Then once the market is done rallying, and then we start to see that demand coming in, we know that the top's in. And we can then start to see that migration higher on insurance, and that's going to bring us down. And we saw the same thing play out again on Friday. So if we look at what happened on Friday, if you were following along with us this week, we have that insurance demand coming in, and we were looking for that downside to continue Thursday because we had PCE and consumer spending both coming out on Friday. Those are going to be the most watched catalysts because everything that is important right now to the market relies on the economy, the tariffs, consumers, because consumers affect our GDP the most out of just about anything that we want to monitor and track. So consumer spending is going to matter. And as we've seen consumer sentiment and consumer confidence begin to slow down, again, we've lost our line in the sand, but the market is still a business. So we're not panicking. We're following these flows. And all it is going from one point to the next and just trading to the extremes. And so we saw that downside move and we had that rally on all that extra insurance in the market that is not needed. And we see that getting taken out. And this was again on Friday. Now, that was after the data release, and then we make our rally. But then people are still uncertain and concerned as we had the meeting at the White House between the Ukrainian president and the POTUS and vice president. And people were a little nervous about what that was going to look like. And so all we did was we got that insurance coming in again. And then at the end of the day, you see that insurance beginning to unwind as it wasn't as bad. Now, we had our level at 48 half, and we showed this before that our students know on Friday at 2 o'clock, we're not likely going any lower. And when we follow the actual flows that are coming into the market, we know that this is not going any higher either. So we know that the low's in, we know that this is the ideal entry point, and we can look for that move up. And that was a 100-point trade. So if you're not capitalizing on some of these and understanding where these flows are, then it's time to level up your game. And you can check out our upcoming courses that start in the next week or two. You can also check out our Discord offerings if you want to get a little bit of the interaction. But if you really want to level up your game, check out the courses and you can check out what our students are saying as well. Now, for the week ahead, we will look for the market to be rotational between this 59.35 and 50 or 60.59 with our pivot at 6,000. Our lower pivot is at 58.82 and our lower target is at 58.09, just ahead of those election levels, which again, you can go back and watch that video from a couple weekends ago that we laid out why that is so important. And on the upside, if we get out of our rotational zone, we're looking for 61.23 and 61.55. And until we break that election level, we are not going to panic. We are just going to follow the flows, follow that line in the sand, and pay attention to all of these because we have just been in this washing machine for the last 5 months, and there's really no reason to expect that to change until we get a clear sign from our levels and from the flows in the market. This is going to be the pain trade for now, as some people are insured for the future, the next 6 months or beyond, and some are left behind in that, some that didn't buy the insurance. And so the pain trade right now is non-directional. And we're seeing that in that elevated volatility and in that purchasing from the commercials of the VIX. And those are things that you want to be paying attention to as we move forward in the next few weeks. So have a great week trading, guys. Be sure to like and subscribe if these videos help you, and have a great rest of your week.